In this video, you're going to learn about WACC, the weighted average cost of capital, which is a more accurate way to determine our discount rate in a DCF analysis. Now, in the previous videos, we went through the DCF, and we saw how one of the critical components of this analysis is determining the discount rate. So when a company earns free cash flows over a period of 5 years or 10 years, something in that range, that's all well and good, but the problem is that money today is worth more than money tomorrow. So for any future cash flows, we have to determine the right amount to discount them by, the right amount by which to reduce their value, and then use that in our valuation. We also have to do the same thing for the terminal value of the company. So the discount rate is extremely important, and it comes up in multiple cases in this analysis. Previously, we had just assumed this simple 10% number right here, which was fine for our purposes for the mechanics of doing this actual analysis. But in investment banking, we like to be more accurate than this, and we like to have a better sense in financial terms what a company's true discount rate should be. So beyond just making a simple assumption here, we like to look at how they've performed historically and their capital structure, as well as some data on the market, and then use that to determine the proper discount rate here. So the approach we usually use is to use something called WACC, which is the weighted average cost of capital. And the way I like to think about this, you'll find various definitions in finance textbooks and other programs, but the way I like to think about this is that from the perspective of the company, it's how much it costs to run their business. From the perspective of the investors in the company, it's the expected return. I should really say expected weighted return right here. So for everyone investing in the company, if we look at their perspective, the equity investors, the debt investors, the preferred stock investors, if we look at all of them and weight their returns, WACC is going to tell us overall how much the average investor in this company can expect to earn over this set of 5 or 10 years. From the perspective of the company, it's how much it actually costs to raise capital, to expand their business, to continue running their business, and so on. The other analogy I like to use here is, let's say that you've taken out loans to complete university and then to buy a car once you've graduated. So maybe you have $20,000 worth of university loans, and then maybe you have $10,000 worth of car loans. The university loans are at an interest rate of 4%. The car loans are at an interest rate of 3%. So in this case, your own weighted average cost of capital, your personal weighted average cost of capital, is simply how much it's costing you to fund your own operations, to fund finishing university and to fund actually being able to drive your car and to be able to use it in daily life. Now, from the perspective of the investors, WACC in this case would tell us for the average investor, if we average the car loan investors as well as the college loan investors, what kind of return can they expect? So in this case, to calculate WACC in this very simple example, we would just take our 20,000 right here, divide it by the sum of these two numbers, multiply it by the 4% right here, and then we would add to it the 10,000 divided by the sum of these two numbers times the 3% right here. Just change the decimal points on this. And as you might have expected, the weighted average cost of capital in this case comes out to 3 2/3%, which makes sense given these numbers. So that's an example of how we would calculate our own personal WACC. And that's really how it works for a company. From the perspective of a company, it's how much it costs to operate. From the perspective of investors, it's their expected return on their investment, weighted across all the different classes of investors. So that's an overview of what WACC, weighted average cost of capital, means and how we actually use it in analysis like this. What we need to do next is start by figuring out some of the key assumptions we need to make in order to calculate WACC. So as you might have inferred, the way we're going to do this is by looking at the cost of equity for the company, the cost of debt, and then the cost of preferred stock. Now for these last two items, debt and preferred stock, figuring out the cost is very easy. It's just the interest rate, or for preferred stock, the dividend percentage rate, how much they're actually paying out in dividends to preferred stockholders. You can find this information in the filings, and it's very straightforward. For cost of equity, though, which is the third source of capital for a company, it gets more tricky because for equity, there's no fixed return on it. There's no fixed percentage rate. So we're going to have to go into some math here and go through a couple steps to actually calculate or approximate the cost of equity. Now, to figure out what the cost of equity should be, let's just think about this from the perspective of the investors for a minute. So cost of equity really means the returns that equity investors can expect. So if you think about it, if they invest in US government bonds, we're going with US bonds in this case because it's a US company. If they invest in US government bonds, they get a fairly safe return. So fairly safe standard return. Whereas if they invest in the stock market, in equities of any kind, then they get a much riskier, more variable return. So our approach to figuring out this cost of equity will be to take what they would earn in US government bonds and then add on the additional return that they can expect by investing in a more risky security, the stock market, equities of companies, as opposed to US government bonds. So that's the basic approach we're going to take. Once we have that, then we're going to adjust this expected stock market return for some of the specific company factors that are unique to Apple and to its comparable companies. But that's the basic approach. We want to look at how much they would get in a safe investment like US government bonds, treasuries, and then add on to it the additional return that they could expect by investing in equities in the stock market. So to get this information, first we need to get their risk-free rate. This is referring to how much they could earn by investing in US Treasuries. The place we usually go to find that, which I have up right here, is this US Treasury government website with daily Treasury long-term rates. We are doing this valuation on January 29th, 2010. So I'm going to look for 0, 1, 2, 9, 10, which we have right here. I'm going to take this 4.38% number right here. So 4.38%. Now, if we go up to the top of the page, we see that we have these 10-year rates and then the 20-year rates. Usually we go with the 20-year rates here, but again, it doesn't matter that much. It varies by bank. Just pick one and go with it, and go with the standard that your bank and your group tends to use here. I'm going to go with the 20-year rates here. So this represents how much investors could get in a so-called safe investment. One other thing I want to do here is briefly footnote this with the website we got it from. So I'm going to press Shift F2 to enter a footnote, and I'm just going to enter the URL of that site right there. Just say daily 20-year treasury rate from, and include that website. Now, if we were working with a foreign company, let's say, in a different country outside the US, we would probably look at the rates, the interest rates on the government bonds in that country instead. For the second part of this, for the equity risk premium, so this represents the return that equity investors, anyone investing in individual stocks, could expect over what they would get in a safe instrument like US government bonds. Now, for this number, there's a lot of controversy about what to use. I've suggested before that you can actually narrow this down to one number and use it like that, but actually, if you look at some of the links I've posted below this video, you'll see that there's a lot of controversy over this. In this Wikipedia article that I've linked to, it says in the third paragraph here, the observed equity premium, the risk premium on equity stocks versus government bonds over the past century was approximately 7% per year. However, over any one decade, the outperformance had great variability, from over 19% to just 3%, 0.3% in the 1970s. So basically, it's telling us that this is really all over the place, and that there's no clear consensus on what to use. To further prove this point, if you look at this other article from this blog, Financial Rounds, which is written by a finance professor, he says here that in finance textbooks, the equity risk premium ranged from 3% to 10%, and that several books actually use different premiums in different pages of the book. So there's no clear consensus on what to use for this. Don't listen to anyone who says there is, because this is one of the biggest controversies in the theory of finance, what to actually use for the equity risk premium. In investment banking, what you typically do is go to a publication called Ibbitson's, and I've linked to the website up here. It's a fairly expensive report, but if you go in here, they actually break it out for each year and do some analysis on what to use for the equity risk premium. Again, there's still controversy about this, and there's no clear-cut answer on what to use for the equity risk premium in any type of WACC or DCF analysis. What I'm going to do here is just assume something in the middle of the range. So I'm going to say 7% because that is the average rate over the past 100 years. It does vary by decade, but usually when you have a controversy like this and there's no clear answer on what to use, you're usually safe picking something in the middle of the range. The other thing to consider here is that in our analysis for the DCF, we actually have sensitivity tables based around the discount rate. So no matter what we pick, we're still going to be looking at a range of values here, but 7% will be our baseline assumption for this analysis. I'm just going to footnote this with Shift F2 and say picked from middle of standard range of 3% to 10%. For the last piece of the puzzle here, for the interest rate on debt, this one we would get from Apple's filings in normal cases. The same would apply if they had had any preferred stock. We would just pull the dividend rate or interest rate on preferred stock from their filings. In this case, Apple has no real debt on their balance sheet, but if you remember from our three-statement model, we were assuming that they were actually taking on debt in year one, in 2010 here. So I'm just going to pull our interest rate of 9%, our assumed interest rate from there. And so now we have all the assumptions we need to begin doing this analysis. Most of the analysis here is going to focus on calculating the cost of equity because that's the trickiest part. But with this in place, now we have the proper setup, and what we're going to do next is move into the first step of calculating the cost of equity. And what we're going to be doing is taking this equity risk premium and figuring out how much to adjust it by. Because this is really just telling us overall how risky the market has been and overall how the average equity investor would have fared over government bonds over the past 100 years. But what we want to do here is not focus on that, but rather focus on how specifically an investor in Apple or similar companies to Apple would have done. And so we're going to adjust it for company-specific factors, and that's what's coming up in the next lesson here.